Hey everyone, thanks for keeping it with us. Once again, I want to thank you for really liking our videos, but also supporting us through the comment section. And of course, we see the support that you give us through the rights and, and how you follow us. Now, last time we were looking at depreciation and we looked at about two methods. And there are some other methods we did not look at because of time. So today we want to complete look at methods that we did not look at in the last session. Now we said that depreciation can be computed through different methods. And we said that there is a straight line method. That one we looked at it at length. That one was covered. We also looked at the reducing balance. If you didn't look at that, then check the previous video about depreciation. Depreciation part 1. Today we want to look at the sum of years digit method, the unit of output method, and the hourly rate method. So, we are going to move direct on and the sum of years digit method. So this one, it has the procedure. If you want to compute depreciation using this method, or if maybe your entity has adopted this method, this is how you compute. First of all, you need to first determine the useful life of the asset. If, for example, you bought a motor vehicle, you need to first determine how long will this motor vehicle be used by this entity. First determine the useful life. Now, after determining that, you determine the sum of the years digits. If, for example, the useful life of the asset is 10 years, how do you get the sum of the years digits? You can use the formula n into n plus 1 divided by 2, where n is the number of years. So, for example, if we had 10 years here, 10 years here, then the sum of years digits would be 10, which is 10 into 10 plus 1. So it would be 10 times 11, and that would give 100. And 10 times 11, use a calculator. In mathematics, we don't believe. Sometimes the heads can deceive. 10 times 11, that one becomes 110. So that you then divide by 2 to get 55 as the sum of digits. So, but if it is now, for our case, we are using 5 years here as an example, then the sum of digits would be 5 into 5 plus 1. 5 into 6, because 5 plus 1 is 6. That would give 30. 30 divided by 2 is 15. That is one way if you use the formula. But also you can add up. We get year 1 plus year 2 plus year 3 plus year 4 plus year 5. Automatically you'll get 15. So you can choose to either use the formula here or you add up with the years here. I think that one is clear. So first estimate the useful life, then after you compute the sum of the years digits. Then after you compute the depreciation. How do you compute the depreciation? Using this method. You get the remaining life. If you are in year 1, the remaining life, if for example an asset has 5 years as estimated, The remaining life is 5 years because it hasn't worked. We are still in year 1. Therefore, the remaining life becomes 5. Then divide by the sum of years digits as computed earlier. For our case, we are considering 5, 5 years, and therefore the sum of digits is 15. So in year 1, if you want to compute depreciation, we will get 5 divided by 15 times the cost of the asset minus scrap if it is there. If the scrap value is not given, you assume it is 0. You simply multiply by the cost of the asset. But if it is given, you consider it. So here we have the practical scenario whereby we are assuming that the cost of the asset is $10,000. Scrap value is $1,000 and the useful life is 5 years. So step number 1 is to estimate the useful life, and it is given to us already. We don't need to estimate. It has been estimated for us. Then step number 2 is to now work out the sum of digits. The sum of years digit, we said you get n into n plus 1 divided by 2. So in this case, you can add. You get year 1 plus year 2, year 3, up to year 5, you get 15 here. Or you can use the other formula, n into n plus 1 divided by 2. n being 5 times 5 plus 1, then that will become 6. So 5 plus 6 becomes 30 divided by 2 to get the 15 here. So that is the sum of digits. So depreciation in year 1, I want you to pay attention here, will be the remaining life, because in year 1 we still have a full useful life of the asset as 5 years. Divided by the sum of digits. The sum of digits is 15 years. I mean 15 as computed. Because if you add up all the years, we get 15. Then times the cost of the asset minus scrap has given to us here, because they told us that the cost is $10,000 and the salvage value is 1,000. So that is how you work it out. 5 over 15 times 9, you get 3,000. That is the depreciation at the end of year 1. So depreciation for the year, if you want to get the net book value now, you get this 3,000, which is the depreciation. You less it from the cost of the asset. The cost of the asset is 10,000. You get the net book value at the date of reporting. That is after year 1. Then for year 2, the remaining life, if the useful life is 5 years and we are in year 2, meaning the remaining useful life is 4 years, because year 1 has gone. We are now in year 2. So the remaining life is 4. So here we shall get 4. We divide by the sum of digits. The sum of years digit, which is 15, times the cost minus survey. So you can see here that the depreciation has reduced. Why? Because this one depreciates the asset when it is new. As the newer it is, the bigger the depreciation. So it charges higher depreciation for assets that are still new or that are still having a large figure of the useful life. Then in year 3, you do the same. In year 3, meaning only 3 years are remaining. The useful life of the asset remaining amounts to 3 years. You get 3 years divided by 15 times cost minus survey. So you can see as you go ahead computing depreciation, it keeps reducing, and at the end of year 5, if you total up all the accumulated depreciation, Maybe we can work it out here. Because they told us that the salvage or the scrap value at the end of the useful life will be 1,000 US dollars. Let us prove ourselves. We have computed the depreciation at the end of year 1 is 5,000. 5,000, I mean 3. It is 3,000. Then at the end of year 2, it is, let us add it to 1,400. Then at the end of year 3, it is 1,800. At the end of year 4, it is 1,200. At the end of year 5, it is 600. The total accumulated depreciation is 9,000. So now that is at the end of the useful life. Let us prove ourselves. If we get the cost of the asset at 10,000, we raise accumulated depreciation here of 9,000. We get salvage as 1,000. The answer is yes. Therefore, that is how we compute depreciation using the sum of years digit method. Let us look at another method, the unit of output method. This one allocates the cost of an asset or depreciate the asset depending on the activity or the output. The output. How many units are being produced by the asset? If the units are many, then the depreciation will be higher. If the asset is idle, then the depreciation will be lower. So that is, and actually this would be the best method for companies and entities to adopt, especially those companies that are dealing in manufacturing. There are some key points we have to note. One, we need to determine the total expected output. If we have, let's assume, a manufacturing plant, what is the expected output? What is its capacity of production? For example, in a certain period, it is a year. In a year, how many units do we expect to be produced by that machine? For how many hours will it work in a full year? Two, we also need to calculate the depreciable base. As usual, the depreciable base is the cost minus scrap value or minus salvage. That one must be computed and, of course, kept with us. Then 3, we also have to determine the depreciation expense per unit, and that one can be obtained by getting the depreciable base divided by total estimated output. So we can get depreciation per unit. Getting the depreciable amount divided by total estimated output. And now, of course, after getting the depreciation per unit, we look at the number of units produced in a certain period. If let's assume 15 tons of cement have been produced by a certain machine, then we can get 15 tons times the depreciation per ton as computed in note 3, in note C. Actually, this is the most easiest. This is the easiest method to use. So we still have the same question here. We are assuming the cost of the asset is 10,000 US dollars. Then we are assuming that the scrap value is 1,000. We are also assuming that the total estimated output is 50,000 units. So we need to first look for the depreciable base because we have the cost and salvage. Get the cost of 10,000 minus scrap value of 1,000 to get 9,000. Then depreciation per unit, of course, we said you get depreciable base divided by the estimated output. So it will be 9,000 divided by 50,000 because the estimated output is 50,000 here to get 0.18. So now, depending if 1,000 units are produced in year one, then depreciation expense will be depreciation per unit times the number of units produced. So when you reach there after getting depreciation per unit, getting depreciation now for the year is a direct deal. You simply multiply and get it. So that one is easier. Then if, for example, 3,000 units are produced, you get depreciation per unit. You multiply by the number of units to get depreciation for that very year. That one is the unit of output method. Then you also have another method, and this method is the hourly rate. In this case, for it, we look at the number of hours in a year the machine or an asset is expected to be used. So in that case, we compute depreciation per hour. Or it can be per day. How many days are in a year? How many days are expected to be used by the asset? So now you get the cost minus scrap, that is the depreciable base, divided by the total number of hours or days an asset is expected to be used in a year. In that case, you will get depreciation per day or depreciation per hour. In case the question comes asking you about hours, they will give you the cost of an asset. They will give you the scrap value of an asset. Then they will give you the estimated number of days an asset is expected to be used in a year. If they expect you to use it for 300 days in a year, you will now know that you to get depreciation per day, you'll get the depreciable base, which is obtained by getting the cost minus scrap. What you get, you divide by the total number of days an asset is expected to be used in a year. By doing that, you will get depreciation per day. Then they will tell you, after getting depreciation per day, how many days did it work? You simply multiply by the days to get depreciation for the year. So that is how you deal with it. And that one, it also goes hand in hand with type apportioning. With this method, you can get depreciation per 2 months. I mean, for 2 months, not necessarily for a year. In this case, type apportioning becomes easier as compared to straight line method and reducing bound method. So members, that is how we compute depreciation. At least we have covered all of the methods. If you find that this video is important or it has done something or it has brought to your attention some of these facts, make sure you subscribe for more videos. We are preparing a lot. A lot is yet to come. What you do is the subscription button, but also like and comment such that we can make our sessions better. Thank you. May God bless you.